Everyone is hedging inflation incorrectly. Inflation is here to stay and it's not going anywhere. So you might as well stop complaining about it and start profiting from it. In this video, I'm going to tell you exactly how you can profit from inflation. Now, why should you listen to me? I was mentored by the Institute of Trading and Portfolio Management ex-Goldman Sachs traders Anton Creel and Edward Scheck, and the portfolio manager of Dragonstone Capital based out of Singapore, managing $3 billion. In addition to that, I have completed multiple specializations and have also created my own algorithm which is running in the markets, which has generated me over a 7,500% return over the last 15 years, all of which you can find in the bio. Don't fight inflation, outsmart it. Why would you fight the ocean when you can learn to surf? Most people try to hedge inflation by buying TIPS, the Treasury Protected Inflation Securities, or by buying bonds. Now, bonds are great, but the issue is that people just take bonds at their face value and don't look at the nominal or the real yield. The nominal yield may be less than 4%, around 3.5, 3.6, but factoring inflation into that, which is around 3% right now, they're effectively earning about 0.6% or something lesser than that. So people need to stop looking at just the nominal return and start calculating their return, the real yield, which is subtracted by inflation, because inflation is going to eat into your returns. Now, given the current economic backdrop and in the Fed context we are in right now, where we're probably going to get rate cuts pretty soon within the next week, inflation, well, we're going to get hyperinflation. It's going to skyrocket. So, how do we profit from this, and where should you be positioned if you want to hedge yourself against inflation? First, you want to look at companies which have pricing power. Companies where they control the prices of goods, companies selling stuff. And as inflation rises, prices increase. The price they sell it at increases too, and that's just pricing power they have on the items they're selling. That's number one. The second one is contemporary art. The thing is, there is only a limited amount of contemporary arts. Unlike money, which can be inflated to infinity, every top contemporary art is finite and hits a status level of its own. And that's what makes it immune to central bank printing and interest rates. It's also a safe asset for the rich. When inflation starts eating into the returns, they'll park the money in contemporary assets. Don't take my word for it. Blue Crest Capital founder Michael Platt is a huge art enthusiast. It also doesn't just appreciate from inflation, but it also appreciates from attention. As more people become more culturally aware, they would start buying more expensive art pieces. So we have companies which have pricing power, where basically they can have control of the prices of the items they're selling. We have contemporary arts. And the third one is gold. Now, there's obviously a lot of news around gold right now. A lot of people are also buying gold right now, and it's recently corrected. Most people think gold's finished. I'm buying more. It's not just me who's buying gold. Ken Griffin, the founder of Citadel, and Ray Dalio, the founder of the hedge fund Bridgewater, are drastically increasing their allocation to gold right now. And you can look at this information through their SEC filings, and it's true. So, in summary, to hedge against inflation, you want to own companies which have pricing power, contemporary arts, gold, and you always want to be calculating your real yield, which is your nominal yield subtracted by the current inflation rate.